Hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It's Thursday, December 12th, and thanks for joining me here on our daily market recap show. We're coming to you live from a beautifully kind of cool, but still wonderful Redmond, Washington. I appreciate you joining me every weekday after the close for our show as we do our best to unpack the action of the day using the practices of technical analysis and behavioral finance, trying to make sense of days like this, which certainly feel like a bit of a risk off move. As we look at the charts today, we're going to dig a little deeper into some of the breadth conditions that have certainly deteriorated here in the month of December. Breadth changed very, very quickly. And although the breadth was quite strong coming out of the elections, November into December really changed the configuration, I would say, breadth-wise. So we're going to talk about the weaker breadth conditions, talk about some of the charts that are still breaking out despite some of the broader weakness we're seeing on a day like today. Couple earnings names to hit on, a little of everything. So let's start with our market recap. Obviously, a bit of distribution here. Anyway, I think you would think of it. The market opened a bit lower. It did rally a little bit out of the morning low, but then really rotated lower in the last 10, 15 minutes. Pretty much the best thing to happen, sort of like when your team is losing, you just want to get to halftime and get to the locker room and reset. Feel like the market just needed the clock to hit 4 p.m. Eastern to wrap the day of trading, because we were in a free fall there at the very end of the day. Not a horribly painful day, to be honest with you, right? The S&P was down about 0.5%. Nasdaq Composite down about 0.2%. The small cap S&P 600, the worst performer besides Canada, down about 8.8%. The only thing in the green on the front page here is the VIX volatility, which again moved slightly higher, right? So about 1/3 of a VIX point to the upside. VIX still below 14. So what we are experiencing right now is what happens when some of the FANG and FANG-like names in those growthy sectors don't go up, right? If you think about yesterday, it was sort of like the FANG sectors up, everything else down. As a result, the major indexes were slightly higher. Today, we have most things down and the FANG stuff down as well. And this is what causes our benchmarks to go lower. So as we talked about, and as we've covered much of the time here in recent weeks, given the dominance, or I guess the reassertion of dominance from the FANG stocks, or the Magnificent Seven names, this is what I think we have to think about. The story of the indexes is very much the story of those mega cap growth names. I think it's a really good time to have key levels picked out, lines in the sand, really understand the momentum conditions with some of those names, and look for signs of deterioration. Earliest signal could come from like an NVDA, which is probably the worst. I mean, I would say undoubtedly the worst of those 8 kind of mega cap growth charts. We'll get to NVIDIA. I think it's the last chart on my list here in a bit. Looking at the other asset classes here, the fixed income markets, rates generally moving higher. The bond market sold off today. The TLT, which is a treasury bond ETF we like to follow, was down about 1.2%. The dollar slightly higher from yesterday. And I would say the trend in the dollar certainly appears to be re-exerting a bit of an uptrend phase for sure. Rates overall going higher here. So earlier in the morning, we had another inflation reading coming in a little warmer, a little hotter than expected. And as a result, growth stocks kind of coming back down to earth a little bit. All right, looking at the commodity space, lots of red here. You had natural gas prices higher, but pretty much everything else was down. Gold getting dinged pretty good, down about 1.5%. Silver prices down almost 3% today. They opened pretty low and then continued to rotate lower. No real signs of accumulation off of that low today. In the cryptocurrency space, Bitcoin, I feel like once again toying with that 100,000 level. We traded above it. We are now back right just below it. Currently just below 100K, to be honest. Earlier in the day today, we did get slightly above 102,000, but overall remaining in that test mode of that big round number of 100,000. Ether, kind of the same story, but 4,000 is the big round number we're talking about there. So certainly keep those levels in mind. We're going to talk about the sectors as a reminder. I appreciate you guys joining in live. Those of you that are watching the live stream on Facebook, on LinkedIn, on YouTube, and on X, thank you so much. If you're watching the replay a little later on our YouTube channel, I'm glad you're tuning in there as well. Whatever is most convenient for you, I'm certainly happy with it. The real benefit of tuning in live is the ability to ask questions. So I can see questions you put into any of those platforms that I mentioned. Wherever you're watching the live stream, wherever you can put a comment, drop it there. I can see those questions come in at the end of the show. I'll try to take a question or two before we wrap the live stream. Anything we don't get to, we'll put it in the chart this mailbag, and hope to answer it in our Friday episode. We're planning an all mailbag episode. Those have been a lot of fun and some real good deep dives into some interesting topics. So your great questions fuel that great content. So I appreciate you asking away. All right. I've given you some time here to look at this chart. Reflecting on the numbers that you see here, what does this mean? So number one, not a huge down day, right? Let's be clear. The worst sector was down less than 1%. So this was not a run for the hills kind of distribution day. This was just more things were down than up kind of day, negative reaction to economic data coming in a little stronger than expected. Again, fears of inflation have not gone away. I feel like they've just been dormant. They've been hibernating, but easy for those fears to wake right back up. And that's the danger of the Fed, talking about being very data dependent, right? When an inflation number comes in a little stronger, then we have to deal with that, accept that, and deal with the potential ramifications. Of course, this is, I think, the last big inflation data point before the Fed meeting next week. That will be the last Fed meeting of the year. We'll get back to the sectors here, but now I'm just going on a tirade of thinking about different things. Just wanted to check the probabilities in the futures market. I mean, no real change here. It's sort of a 95% probability as being priced into the market that the Fed lowers rates by about 25 basis points at the December meeting. That means a 5% chance that they remain the same, and nothing else really getting priced in here. Again, the real question, I would say, besides this foregone conclusion of a 25 basis point cut, which I think makes sense and I think will most likely be the outcome, the real question next week will be forward looking and what the pace of future rate cuts going into 2025 may look like, what that terminal rate might be, which I think is certainly open to debate and discussion. We'll see how the Fed governors and the reports that we get and the press conference next week, especially, I would expect a lot of questions along those lines, teasing out that potential path of further rate cuts. All right, back to the market recap. Consumer staples, your best performer, up 0.3%. Communications slightly higher. Utilities essentially unchanged, along with real estate. So that's 3 of the 4 top sectors are pretty defensive. On the downside, energy and consumer discretionary and healthcare all down about 0.8%. From Wednesday's close. All right, let's look at the Magnificent Seven and friends, the mega cap leadership names. These names were all up pretty big, if I remember correctly from yesterday. Today, down a bit. Apple and Microsoft did finish slightly higher. Those are probably 2 of the laggards of the group in terms of the Magnificent Seven in recent history, although NVIDIA is has been the outlier for the most part. Alphabet down almost 2% today. Tesla down 1.6%. NVIDIA down 1.4%. Can't stress enough. I can't overstate the importance of watching these 8 charts and other large mega cap growth names. I think that's the market here. By the way, the latest episode of our podcast just recorded earlier today. We had a conversation with T.G. Watkins earlier this week. Earlier today, I sat down virtually with Frank Capilleri of Cap Thesis. He's a fellow CNBC contributor, really knowledgeable technical analyst. We've sort of come in around the same time. He came in a little earlier than I did in the late 90s, but we're sort of at a similar, came in at a similar era, kind of that late 90s era, tech bubble bursting kind of era, and now have grown as technical analysts through that period. It was a lot of fun talking about the performance in 2024, looking forward to 2025. And we talked in particular about the dominance of mega cap growth and thinking about deteriorating breadth conditions relative to the real proven strength of some of those names. So I'll leave it to that episode, not posted yet, hopefully later today or maybe tomorrow morning. We'll get that episode out to all of you, but you can check out all of those podcast interviews on our YouTube channel. All right, continuing on here, looking at the market carpet, a heat map style visualization. Boy, it's sort of a series of warm colors here, right? This is warm color, red and orangish and yellow on the heat map. You're seeing pockets of little green, but for the most part, this was a distribution day. Now, it felt a lot more like a distribution day given the weakness of some of these larger names like NVIDIA, Alphabet, Tesla, as we covered earlier. All dropping, and some of the other names that aren't part of the Magnificent Seven, but still pretty big growth names like Oracle, which has been really sort of pushing up against that 190 to 195 range, breaking down to a new swing low. Broadcom, we're really testing resistance, failing to break out today. So it's not just the Magnificent Seven; it's a lot of charts sort of struggling today. So, general observation, distribution day. In terms of the largest names, I'm noting Alphabet and Microsoft, Apple and Microsoft up today, even though the average sort of large cap growth name was down. Also noting Salesforce.com, IBM kind of bouncing higher on a down day. Anytime you have a down day, I always want to look at what did something different. So I'm immediately drawn to stocks like Intel, which is kind of an outlier in the semiconductor space, kind of a different business than a lot of the other semiconductor names. Pretty ugly chart. We're down in the 20s, right? Testing that $20 range. It's up about 3%. Still a lot to prove. I think that's a good chart over like 25, not over 20, but nice to see it up on a down day for stocks. Also noticing in the staples sector, something like Hershey's maybe bouncing and maybe mounting a nice recovery off of a low around 170. Kroger coming off the sort of unwinding of the Albertsons Kroger merger. That's one that's followed pretty closely here because those are the two big chains in the Seattle area that I know about, besides some others. But those are two that are pretty common. So that unwinding for now, giving Kroger a nice boost over 3% to the upside. CHRW, CH Robinson, which is in the, I think that's a trucking group or industrial, I forget which group that's actually in, but in the industrial sector, making a new 52-week high today. So on a day like this, when charts are going lower, I would always encourage you to focus on what did not go down, what bucked the trend, what managed to at least have a positive day when other things are down. While that might not mean a screaming buy signal in your book, it certainly, for me, tells me to reevaluate some of those metrics. All right, continue on to the chart review. I do see some questions coming in. I appreciate you guys so much asking thoughtful questions. As always, keep them coming. Anything we don't get to, we'll put it in the mailbag and hope to answer a question Friday. That's tomorrow. Man, the week has gone by very quickly. All right, looking at the daily chart of the S&P 500, I would say no change generally in terms of my, my assessment of the trend here. I think of the daily chart as my main go-to representation of the tactical time frame, the short-term time frame in my book. I would say, certainly we're in a consolidation pattern here in the last week, coming off of the rally from mid-November to early December. We've now had a week and a half of kind of chopping around that 6,000 to 6,100 range. For now, 6,100, the short-term peak, 6,000, maybe a little above there is kind of that swing low, just this brief little kind of pennant pattern. But the real line for me is that 5850 level, as we've covered many times. I don't need to rehash that entire thing. I think that's the level. So when the market keeps going higher, I tend to bump up that line in the sand, just that level at which you think you want to revisit general approach and general trend assessment. For now, trend is positive. Recently coming out of an overbought condition, just brief. I mean, just barely touched the 70 levels, so not extremely overbought or anything. But last time we hit 70 was end of the first week in November. We pulled back a bit and then resumed the uptrend. So an uptrend will have pullbacks, right? And that's what we have to remember. Just because you have a big down day doesn't mean, now what? It just means normal, right? I mean, it could just be a normal pullback within an uptrend. Some of the biggest down days you're ever going to see are in uptrends, right? In broader uptrends, because there's profit taking, there are pullbacks along the way up. That's why we focus on making sure we print a higher low on the pullback. That's why that's so important, because that implies that uptrend is in place. S&P over 5850, still a pretty decent chart. All right. With the remainder of our chart review, two things we're going to do. Number one, go rapid fire through a bunch of breadth indicators. I've kind of handpicked these randomly to highlight things. I just want to sort of give a state of the union breadth-wise and hit on some of those key metrics and focus on what they're telling us. Then we'll look at some individual stocks to finish off. Actually, a number of them that I pulled that were on my list earlier in the day for one reason or another. So the month of December is just this little blip on the far right side of this 2-year chart. This is what we call our newer Dow theory. This is looking at the equal-weighted S&P 500 and the equal-weighted Nasdaq 100. The idea that Charles Dow sort of came up with was looking at two main indexes. And if they're both breaking out, that's good. If they're both breaking down, that's bad. If one's breaking out and the other is not, that's a non-confirmation and a potential reversal. So what you're looking for when the market is in such a position of strength is either one of these breaks out and the other one does not. We're not seeing that here because, as you can see here, late November, early December, both of these have made new 52-week highs. So we're going up. The other option is you have a confirmed breakdown, meaning both of those make a new swing low. And again, we're still kind of above those levels. So newer Dow theory telling you we're still okay. I just want to highlight the fact that the equal-weighted S&P kind of heading straight down in the month of December. Again, only a week and a half old, but kind of tells you the general trends we've observed. I did change my proprietary and very scientifically based, and I say that with a great deal of sarcasm, my advanced decline line chart. I literally every day take a look and I color code them green, neutral orange, or bearish red, depending on how I see these trends. My general approach is if they're making new highs and above an upward sloping 50-day moving average, that's bullish. When they break below the 50-day, that's neutral. And when it breaks to a new swing low, that's bearish. Two of these, and actually three maybe today. I'll have to check the tape. I think that actually just finished slightly below the S&P's AD line, which means 3 out of the 4 in neutral orange, and that just happened in the last day or two. The S&P small cap AD line for now still remaining above its 50-day moving average. The main one's the New York Stock Exchange. It's a broad universe, has large, mid, small, all kind of thrown together. That breaking down tells me to be a little bit concerned about breadth conditions. The McClellan oscillator, as we've documented here over the last week, coming out of the Thanksgiving holiday, broke below 0. That is a short-term breadth indicator based on the advanced decline data and smoothed out with some moving averages. I would say overall that tells you the short-term breadth is negative. As a reminder, that is one of the components of the Hindenburg omen. Has not quite fired yet. Could happen today with all the distribution we had. We'll have to take a look here once the final closing data is all sort of logged up. But overall, very close to getting that confirmation. The McClellan oscillator has already flashed a sell signal breaking below the 0 line. We're seeing less new 52-week highs, and we're starting to see a few more new 52-week lows. It's not a climactically negative amount by any means. It's sort of right now kind of dead even between new 52-week highs and new 52-week lows. There aren't a lot of either of them. Things that have been in primary uptrends, besides a relatively small number that are continuing to go higher, a lot of things that have been in nice uptrends are pulling back a bit here over the last week or two. And a lot of the things that are near their new 52-week lows are not quite breaking down, right? There's a lot of things kind of in the middle within that range, and that's what that chart is sort of telling you. We are almost to under 50% of S&P members above their 50-day moving average. It's almost dead even, a coin flip right now, right at 50%. As a reminder, at the end of September, that was around 82%. At the end of November, just 2 weeks ago, we were just above 70%. So in the last 2 weeks, about 20% of the S&P members, about 100 names, have broken down through their 50-day moving average. So when we talk about the indexes remaining strong, but the breadth getting weaker, what this chart tells you is that a lot of stocks are actually in full pullback mode. Even though the benchmarks themselves are not yet, they're still kind of okay, right? The chart of the S&P is kind of going up, and I don't think that's debatable. But this tells you that a lot of stocks do not look like the chart of the S&P, and that usually makes me a little uncomfortable about the sustainability of the uptrend. The bullish percent index had been above the 70% level, broke back below it here going into this week, and as a result, that is one of the kind of infrequent but pretty meaningful main sell signals telling you that the breadth was excessively bullish and now is starting to come down a little bit. Shaken money flow, to talk not about breadth but about volume. This is my favorite way of thinking about trends in volume. I mean, certainly if you just look at the raw volume data on the SPY, certainly seems to me like it's not trending upwards. We're not seeing an uptrend on stronger volume. We're seeing the price go up on weaker volume. The shaken money flow does a little more rigorous calculations trying to assign directional volume based on where we close relative to the range of the day, which I think is a brilliant way that Mark Chaikin came up with. Over the last week, that has been trending clearly downwards. And so when the market's sort of pushing to new highs on weaker volume, on weaker breadth, those are potential signs for concern. Now, all of that kind of can be summarized with the McClellan oscillator. I've had a number of questions on this since I sort of made noise about that initial signal just before Thanksgiving. The short answer is not quite yet. All the things have triggered, except you need at least 2.5% of NYSE listings making a new 52-week high, and at least that same number making a new 52-week low on the same day. We just haven't gotten that. We've gotten really, really, really close, but have not quite gotten that metric that is a built-in part of the indicator. So for what it's worth, and again, this isn't the only indicator that I use. I don't think it's the end of the world either way if we get a signal or not, but I have seen when we do get sell signals from the McClellan oscillator or from the Hindenburg Omen, it doesn't happen very often. And when it does, it behooves you to follow that and pay attention. Major tops have happened after these signals have manifested. So I am definitely keenly aware we're sort of in that year-end window dressing. I think that could be a big part of the Magnificent Seven names doing so well right about now. If I'm a money manager, I probably want to be pretty well exposed to those names, because if I'm a client, that's what I'd want to see, because that's the juice. Those are the names that are doing so well. However, going into the beginning of next year, that's when that window dressing argument goes away. And now it's just about what sort of risk money managers want to take in their portfolios. And if enough investors get defensive, the market can go down. So if that is the condition, if the breadth is less ideal, if the volume is deteriorating, if we have distribution days like we're seeing today, where 9 out of 11 sectors are going down, what do we do? What's that confirmation that things are not just looking like they could get bad, but actually getting bad? I've asked this question of a number of my interviewees recently on my podcast called Market Misbehavior. As I mentioned earlier, a number of them, not all of them, but a number of them highlighted a chart kind of like this one. Look to volatility, right? One of my mentors, Ralph Acampora, used to say the market goes up the escalator and down the elevator. When the market goes higher, there tends to be this gradual uptrend. We've experienced that arguably for much of 2024, similar to 2021. Another kind of low volatility uptrend year is 2017, another good example of that. At the end of that uptrend, though, at some point, there starts to be profit taking, sort of the smart money maybe starts to unwind positions, investors get defensive, whatever it is, we start to see distribution. That initial distribution causes an increase in volatility that fuels further selling, which increases the volatility, which fuels further selling. And there's that feedback loop of the market selling off on increasing volatility. So besides just using, the line in the sand technique and say S&P 5850, wake me when that's broken, the other thing you can do is look for a spike in volatility and sort of identify that regardless of what's happening with price, investors are getting less comfortable or less, what's the word I want to use here? Complacent, maybe, getting a little more nervous, a little more anxious. And that's reflected with an increase in volatility. VIX is still in the nothing to worry about kind of range. So again, I see a pretty clear path, which is a spike in volatility with the S&P breaking below 5850. At some point that happens, you'll hear me take a much less happy, optimistic tone. I'll probably still be happy and still be smiling, but it will be much more of a, let's watch out for what may come next. And let's start to think defensively for sure. All right, let's look at some individual stocks here to finish things off. C.H. Robinson Worldwide, I mentioned when we were looking at the market carpet, making a new 52-week high today. And again, if there's one thing I've learned in a number of couple decades analyzing charts pretty much every day, I will tell you that regardless of what the broad market is doing, some stock somewhere, some chart is breaking out. And I learned that from reading IBD, reading Investors Business Daily every morning. And I remember reading that in like 2008 and 2009, in 2001 and 2002, clear distribution years where the trend overall was certainly risk off, but some stocks were working. And that's a reminder that in any environment, something somewhere is probably working. So it's a good idea, I would say, as always, to use scanning tools to look for stocks breaking out, particularly in periods like this where it feels like a lot of things are kind of rotating off of their highs. Look for CHRW kind of charts that are breaking out despite the broader market weakness. There might be something there that you want to follow. I would say from a technical perspective, pushing above this 110 to 112 range is a pretty nice breakout. You'd actually call this an inverse head and shoulders continuation pattern if you ever get asked that on a quiz, because you have a rally, then you kind of have this upside down head and shoulders pattern. The neckline is what's most important. Today we break out. Tomorrow I would look to see if there's follow through. Do we follow through on that 4.5% gain today with further upside? WBD, Warner Brothers Discovery, announcing earlier today the non-technical reason they talked about sort of breaking up their two businesses, the streaming business and it was called the linear business or something, I believe was what the term that I saw, but basically more of the traditional stuff from more of the streaming parts of the WBD kind of conglomerate of entertainment brands now. Market taking that as pretty good news, up about 15%. This follows on other entertainment companies doing, and media companies doing a similar kind of thing, and the market overall giving that a big thumbs up. The price rallying up about 15%. I would say the chart has been impressive from back here. This is when we started highlighting that name, when it gapped above resistance and then continued. This is just the latest follow through in the uptrend. Broadcom, so when you think about what you would need to see to sort of shake off this short-term pessimism and get renewed optimism for further upside, I would be looking for charts like Broadcom to be breaking out. NVIDIA, which is a chart we'll look at in a minute, I look for that to break out. When it does break out, I'd go in meta mode. Meta breaking above $600 a share. The question is, does it hold that breakout? For a market to continue in a bullish framework, you need stocks breaking out. These large cap growth names that are they're the market at this point. You need them to break out, and the ones that do make breakout, you need them to continue to show appreciation. Because if that doesn't happen, right, if we can't break above resistance, if breakouts like Meta aren't sustained, that tells you there's an evaporation of buyers, right? That sort of anecdotal buyer that's willing to push prices higher is no longer coming to play. And then there's who's going to push the price even further, right? No one is the problem. So Broadcom, I would say, hitting a major league resistance level around 185. That was first tested in June, retested in October, November, and now in December. If and when we get above 185, I think that's an impressive chart and a nice breakout. Until that happens, though, I would be skeptical. It seems to be setting up in a good way, but I think it's good to be patient. Costco will have a couple of earnings names here. Broadcom is one of those. Costco today as well. I don't have time to check the after-hour session, but certainly think of these. These are three earnings names today. Broadcom today, Costco today. Overall has recently broken above resistance, and I think that's in a good technical configuration going into earnings. For JCI, Johnson Controls, which is in that buildings materials group within industrials, had broken to a new high after gapping up around the elections, pulled back a bit, and now is kind of range bound between 82 and 85. I would want to see after earnings if we can break out and resolve to the upside. If so, I think that's a pretty good signal. If we would break below the 50-day, which has held as support a number of times in the last 6 months, I would be avoiding a chart like that until we get some sign of stability. I mentioned interviewing one of my fellow CNBC contributors, Frank Capillari, earlier today. I'll have that episode of the Market Misbehavior podcast for you very soon. And I've promised we're getting the podcast onto the traditional podcast platforms like Spotify and Apple. That is in the works. Still processing some edit audio and getting everything lined up, but hopefully we'll be out to you real soon. For now, you can watch all those episodes on our YouTube channel. And speaking of Frank, I was talking to him about that article I just posted on CNBC Pro. We talked about NVIDIA in this consolidation phase, the likelihood of a potential breakdown given the absence of any signs of accumulation. The volume picture is actually a lot weaker. The momentum picture is a lot weaker. You can check out that full article and all the charts in all their glory at cnbc.com. Look for the Chart Investing Pro section. All right, let's take a question or two. How cheap can CVS get? Michael, thanks so much for asking this on the YouTubes. I appreciate you following my work and asking about CVS. Let's bring up the chart. So, funny story about a chart like this. We in my days at Fidelity, I worked in the chart room as part of a really fun part of my job was managing this beautiful, at the time, huge physical space dedicated to market history and dedicated to technical analysis. We had a 13-foot plasma screen, which they still have there in one of the main conference rooms. And we would bring in portfolio managers, look at their holdings, and have a lot of fun as a team using that to look at huge, larger than life charts. I mean, it was a huge monitor. It was awesome. And one of the things we would always laugh about and we would say is don't confuse the bottom of the screen with support. And back in the day, people would say, don't confuse the bottom of the page with support. We have a piece of chart graph paper and the chart keeps going down. You would add paper to the chart, right? You literally tape together a new piece of paper. And that was always one of the sort of anecdotal signals, right? When the chart would be so bad, you'd have to tape a new piece of paper below the previous scale, Or if the chart would literally go through the roof and you'd have to add paper above it, that would tell you something about the condition. So, just because something like CVS has gone down a lot, don't think it can't go down a lot further, right? I mean, market history is full of examples of stocks that had initial breakdowns, and then that led to much further downside. And we don't want to think that a stock can get below $50. It can. And we don't want to think it can get below 40 or 30 or 20 or 10 or 5. All of those things could happen. Now, do I think that's a likely scenario at this point? Not necessarily, but I would say that just because something has broken down, for me, I would never think of that as a buy signal. I would think of that as the type of chart I would avoid like the plague until you see signs of accumulation. So you have two general ideas or two general approaches on something like CVS that's breaking down to a new 52-week low. Number one, you buy extreme weakness and you use stops, you use money management techniques to minimize your losses in case you buy and the stock just keeps going down and no bottom occurs, or you patiently wait for a sign of accumulation. And this is much more how I tend to think of things. I put this on a watch list. I look for things like the RSI giving a bullish divergence like we saw in May of this year. I look for the PPO indicator, particularly on the weekly chart, giving a buy signal. Something like the DeMark indicators, which we don't talk about a lot. We don't have them on the stock charts platforms. I don't look at them day to day as much as I used to, but the TD sequential indicator is designed to count conditions leading down to an exhaustion point or a potential exhaustion point in a downtrend. Those are all things I would be looking for, but until then, don't confuse the bottom of the page with support is my main suggestion to you. And thanks for asking about CVS. One more question. Titus Ryder, thanks for watching. As always, you asked, since you once worked at a large investment firm, don't they have a research department that calculates CPI and PPI numbers? It's hard to believe they'd wait for the Fed's numbers. So yeah, you're not wrong. I would tell you that one of the great advantages in, at times with working at a large financial firm, which you had a huge research department. I know that was the case for me. And you just had a ton of data. You had a ton of resources. You had a ton of, groups of people. We had, interns and junior analysts that you could say, hey, go break this down and recreate a CPI number, but use these other assumptions. And they could go do it and come back a day later and show the results. And I missed that capability because that was a lot of fun to just think of different ideas and try to tease as much as we could out of the data. At the end of the day, though, as much as they might have an educated guess, they don't know for sure. Fed governors, that part of the industry, really more on the regulatory side, there is a huge separation. There's no, internal whisper number that we would have gotten. It was really more, smart people with PhDs in math and physics, trying to recreate things and trying to model them. You better believe we would have done that. Did that lead us to dramatically better results? I don't know if that's true, but you certainly would try. And I think that's one of the things you do when you have a lot of resources is try anything you can to get an edge. I would say, decades ago, pre all the financial regulations, which are now commonplace, which I think is a very good thing. One of the great advantages of working at a large firm was you had a lot of inside information. It was, just not as regulated or not as frowned upon probably as it should have been post financial crisis, post 2000. All of that has changed and all of that has been cleaned up in a pretty big way. So there's no real information advantage. There's just computing advantage, but boy, that's going away too because of AI and all the tools that you and I have available to on web-based AI products. So the answer is short answer. That was a long-winded way of saying, yes, I'm quite certain they try to do that. Does that mean they dramatically do better because they have some advantage of being able to calculate it? I'm not sure. I would say a lot of big investors are surprised just as much as you when numbers come in higher or lower than expected. That's it, folks. I want to thank you guys so much for tuning in, for watching the show. If you're watching it live, or if you're watching the replay, I can't thank you enough for doing so. As a reminder, our Market Misbehavior podcast is really clicking, and we're having a lot of fun interviewing some smart people, some knowledgeable analysts, money managers, strategists. If you have suggestions on who we could interview, drop a comment wherever you're watching this and let me know. We're always looking for some people to approach. We're starting to sketch out Q1 and interested to see who I should sit down with. I'm always happy to do it. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night.